Annuities get a bad rap. They're always getting knocked by somebody for something. They're confusing. Some of them have really high fees. Some of these are valid reasons, but today I'm going to give you 3 reasons to consider why you might want to use an annuity in your own portfolio. And make sure you stick around to the end because I'm going to go over an often overlooked part of annuities that can actually be really beneficial, and I'll break it all down for you. So reason number 1, annuities are all about retirement, and the most important thing to any financial retirement plan is income. What do you have coming in every month versus what do you have going out, and making sure that you've got enough money coming in retirement without having to maybe draw from the portfolio or assets that can fluctuate. An income gap when you plan to retire. What will you have coming in every month? What will you have going out every month? If it looks like this, I've got pension and social security, etc. Here's my expenses, and then I've got my pile of money over there, all the money I've put away for the future. You're probably in pretty good shape because from a starting point, you've got excess income coming in. If you look like this when you retire, which a lot of folks do, maybe I've got a social security check, or me and my spouse have a check, but it doesn't meet all of our monthly expenses. And then we've got our portfolio, all the money we saved for the future. Backfilling that gap with guaranteed income can be beneficial. Annuities can provide guaranteed income. The guarantee comes from the insurance company who's offering you the annuity. That's important, but suffice it to say, the first reason to look at an annuity for retirement purposes is to create income in retirement to shore up that income gap and get yourself squared away with a good amount coming in every month. Now, the second reason to consider an annuity is that you don't want all of your money in something that can fluctuate. You don't want all of your money in the stock market. And so you have your money in the bank, and then for a lot of folks, they've got their investment portfolio, stocks, bonds, mutual funds, things that can live like this and fluctuate. And while you need to have those assets to help you grow over time and support future income needs and future goals, sometimes you don't want to have all of your money sitting like that. You'd like some of it to live like this, to have a principal guarantee and simply to grow over time. And there are varieties of annuities that do just that. But for somebody who doesn't want all of their money in the market, doesn't want all of their money to fluctuate, and is looking to build sort of a foundation to the financial plan, some money that lives like this and just grows maybe a little more slowly and steadily over time, annuities can fill that void, and for a portion of your portfolio can provide value. By the way, if you haven't seen me before, my name is Antonio Cibella. I'm a financial advisor who works with folks who are planning their retirement, trying to make sense of the messy financial situation that we live in and help guide them through that process. If you're enjoying the video, subscribe to the channel. Come on back, check out some of our other stuff, because if you do, you'll get notified every time we put up new content. I get something up once a week, twice a week, all about retirement saving for the future. Now we're on to reason number 3, the often overlooked original benefit, the OG of why you would buy an annuity, and it was this: tax deferral. When you put money away into a normal investment account, non-qualified, I'm not talking about 401ks and IRAs and things that have special tax treatment, qualified money. I'm talking about non-qualified money. This is just money that I earned and I saved and I want to put it somewhere and I would like to earn something from it. In those accounts, without some sort of special tax treatment, you pay as you go. As you earn income from it, as you earn a return on your investment, you pay taxes as it happens. Originally, annuities were designed to be a retirement vehicle that provided tax deferral, meaning you don't pay taxes as you earn in the account. You pay taxes at the end when you would use the money, when you would pull it out. So it's not tax-free money, it is tax deferred, but you now have control over when you're going to pay those taxes, because you're going to be taxed on it when you use it rather than when you earn it. This is particularly valuable for high income earners. If you're already maxing out your 401k, you're maxing out your IRA, and you're looking for another place to put money and it's future money, you don't need to use it right now, you can utilize an annuity, wrap that money in tax deferral, and as it's earning, you're not paying the taxes on it. You're avoiding something called tax drag. I told you, stick around so that you could see how this actually works, and I'm going to show that to you now. I'm going to pop a graphic up on the screen, and the way that non-qualified money works, when you earn from it, you pay the taxes each year. So let's say that you had an 8% return. Well, if you have to pay taxes on it, you didn't actually net out 8%. It was 8% minus whatever your tax rate is. That's tax drag. 2 steps forward, 1 step back. 2 steps forward, 1 step back. Every year you earn, and then you lose a little bit of that gain by paying taxes on the gains because there's no preferential tax treatment for that money. If it's done inside of a non-qualified annuity, you're not paying tax each year while you're earning those returns. And that's what this graphic shows. So the graphic shows what happens to $100,000 that earns a 6% return average per year over the course of 30 years. And so as you can see here, because you didn't pay taxes on it as it was earning, it grows substantially higher over the 30-year period. At the end of the 30 years, your tax deferred account is over $574,000 before any taxes would come out, whereas your after tax, been paying as you're going tax account has grown to $304,000. Not bad, but certainly a lot less. Now, here's the thing, because it's tax deferred, it's not tax free. You don't get to walk with $574,000. You're gonna have to pay tax on the gains, not the original $100,000 principal, but on the gains that have not yet been taxed. Uncle Sam wants his piece. So if you were in a 37% tax bracket, as the example shows, even after paying tax on all the gain, you'd still walk with $398,000. $398,000 is more than $304,000. That extra $94,000 of money that you get to keep and you did not have to send off to the federal government is the result of tax deferral and not taking 2 steps forward, 1 step back, but simply 2 steps forward, 2 steps forward, 2 steps forward. And then at the end, as you would draw the money out, you take your steps back, not while you're earning. It allows more of your money to continue to earn for you, and as a result, limits losing some of those gains along the way to taxes. While you're watching retirement-oriented videos on YouTube, I got a good one for you. Go ahead and click right here. I'm asked all the time by clients, are annuities good for income? I was asked enough times I decided to make a video about it. Check it out. You can see if it'll work for you.